Hello, gentlemen. Greg Michalowski from ForexLive.com coming to you from rainy Phoenix, Easter Sunday. For those who celebrate, happy Easter to you. In this Kickstart video for the new trading week, I'm going to take a look at some of the major currency pairs. So let's get started. Looking at the Euro versus US dollar. This is the trading week range that we saw last week. The end of the last week, we recall we came down and we tested this swing area right through here. Where we had a number of different swing lows forming this floor right through here. And in videos at the beginning of last week, we talked about having to either get through that level on the downside or bounce off of that level and move higher. On the top side, we had the moving averages, including this 200-day moving average. You can barely see it, but the 50% retracement also is right there. We also had the 100-hour moving average, and we came up and tested that. We came up and tested this blue line right here, which is now covered by the red line, which represents the 100-day moving average, and we found willing sellers against that level, and also the 200-hour moving average was moving to the downside. So things kind of worked up progressively to the upside through technical levels to start the trading week, and then things started to move to the downside. And what did we do? We found willing sellers against the 100-hour moving average, not once, not twice, but three separate times. This time finally came up well short of that. We started to move lower, and we traded on Friday at the lowest level for the week before rebounding. Where did we rebound? We rebounded back into that yellow area right here, back near the 61.8% retracement, finding the willing sellers. So whereas last week we were trading just above this yellow area, this week we're trading just below the, or we close the week just below the yellow area, and that tilts the bias a little bit to the downside. So, sort of an up and down week. With the price returning, but with a slightly negative tilt going into this week. In this week, we're obviously, if the buyers are going to take more control, we're going to need to get above that yellow area, the 61.8% retracement, 1.08036 in particular, and then we're going to need to get above the 100-hour moving average. Why? Because we held it not once, but twice, but three times right through here. So we're going to need to get above all those levels, and then we start to look again toward the 200-day moving average, toward the 50%. Toward the 200-hour moving average. All of those converge right up here near the 1.08374. Of course, the 100-hour moving average is going to be starting to move lower, so that's going to be the first one they're going to need to break in order to increase and tilt the bias more to the upside. From there, we head up back toward the 100-day moving average, this swing area right through here as well. On the downside, stay below this level, and right now the sellers are more in control below this level. And we have to look forward to these lows right through here, and then we start to pick away at the other lows that we had in the month of February, including 1.0731 and 1.06942. So right now, sellers are more in control in the euro versus US dollar. 108.036 is a really close resistance, followed by the 100-hour moving average, 108.146. And if we can stay below those levels, the bears remain in control, move back above, and the story changes a little bit. My name is Greg Michalowski. Let's take a look at the dollar versus yen next. The next currency pair I'm going to take a look at is the dollar versus yen as we start the new trading week starting April 1st. So let's get started. I'm starting on the daily chart for this currency pair. And if we go back in time and take a look at the 2022 high that came in at 151.94. If we go back to 2023, the high price came in at 151.91, and in trading on Wednesday of last week, the high price came in at 151.967, just 2 or so pips above the previous all-time our high level going back to 2022. And the significance of just breaking 2 pips above that high is that it also represented the 30-plus year high price for the dollar versus yen. Yes, going back to 1990 was the last time the price traded that high, and it could only get 2 pips above the previous high. That was disappointing. We started to rotate to the downside. The thing is that the rotation to the downside was not much, so the buyers remain more in control. Here on the daily chart, we would have to get below this level 150.88 to start to show some gains from the shorts, at least on the daily chart. And as you can see in last week's trading, we didn't get down to that level at all. So keep that level in mind, 150.88. Now let's go to the hourly chart and take a look at that. And if we look at the hourly chart, what did the price action look like in last week's trading? Well, these are the 5 days of trading that we had in this currency pair. I'm going to make a box here around this. And you can see that the low price that we saw on Wednesday equaled near the low price that we saw last Friday, and also this low price right here on Monday. And so all those three lows joined in to find support at 150.997. Nice round number. Remember, the 88 level on the daily chart was something of significance. And that kind of goes back to this area right through here, where we had a number of different swing highs forming the ceiling here. So it's not only the 88 level, it's really 71 up to about the 88 level on the top side that the sellers were leaning against. Then we had this break to the downside on this day, but that was the last time the price traded below this swing area right through here. So going into the new trading week, the way that I see this is that if the price is going to go lower, and it was the same story that we had last week, we need to stay below these 100 and 200 hour moving averages, just the blue and green lines right through here. Stay below those levels, and then we start to push down toward our low prices through here, where we had these swing lows from last week and the week before. And then we need to get below the 38.2. This is just of the last move to the upside here. And more importantly, the swing area right here down to 150.71.8 up to 150.88. If we're able to get below those levels, it opens the door for further selling momentum or potential for momentum on the back of just the technicals tilting more to the downside. On the top side, we're going to need to get above the 100 and 200 hour moving averages and stay above those levels to increase the bullish bias and have traders looking back to again toward the 91 level, 94 level, 967 level. Those were again our successive high prices. Well, not really. It was 94, 91, and 96.7 for 2022, 2023, 2024. Need to get above all those levels and stay above those levels to increase the bullish bias for the dollar versus yen. Next currency pair I'm going to take a look at is the sterling versus US dollar. So let's get started. The next currency pair I'm going to take a look at is the sterling versus US dollar. I'm going to focus on the 4-hour chart here, and this has become more of a cliche than anything else. Is this swing area through here, which really I'm going to take down to the 200-day moving average. It was 94 to 1.26137 as the swing area on the downside. Where the value area, this is the value area where most of the trading has taken place over the last going back to December, folks. So however weeks this is, because this is a 4-hour chart, each of these dashed lines represents a trading week. But we're going to need to get outside of this range, and we're still in it, okay? We're still in it. And what we saw in trading last week was that the price high that we, or one of the highs, at least toward the end of the week, came up to the 100-day moving average, and nice had sellers against that level at 126.46. So earlier in the week, yes, the price moved above and below the 100-day moving average, but could not sustain much momentum above those levels. We tried to stay above it through here at the beginning of the week, and then this time toward the middle of the week, the price moved above it just briefly and then rotated back to the downside. So the holding of that 100-day moving average on Friday put a lid at the 100-day moving average, and that's going to be key resistance starting the trading week this week. As long as the price remains below that level, the bias remains more to the downside. On the downside, we do need to get below the swing area down through here between 125.94 and 126.13.7. And also, as I mentioned, we're going to add the 200-day moving average into the picture. Why? Because it's a key moving average, and although the price did move below it, not in trading last week right here, we also moved below it here, but each of the time it broke below that swing area and the 200-day moving average. It wasn't for a long time. So the sellers have to prove themselves that they can get through that level and stay below that level to increase the bearish bias. If they can, then we start to trade outside of this value area. And if trading outside the value area leads to another, another area that the market can focus on, and then reuse this area as resistance. So that's a storyline from a technical perspective on the downside. The next target after that would be the low price of from the year, which comes all the way down at 125.17. Now, conversely, if the price were to move back above the 100-day moving average, we move back into the more into the heart of our red box through here, and we'll start to look toward the 200-hour moving average up here. We'll start to look toward the 50% of the range since the beginning of the year. That comes in at 127.053, and the 100-bar moving average on the 4-hour chart at 127.053, I should say, 127.165, and get above those clusters of moving averages, and we start to look toward the high, which, by the way, the high price that we saw not last week but the week before did a pretty good job of kind of holding resistance near the high of our red box area, and it was sort of like the down here where the price moved briefly below these levels right through here. In this case, it moved very briefly above those levels. So, that would be the next target to get to and through. And if it can't get above that level, that would open the door for the high price for the year, 128.93. So it's very symmetrical. We have an extreme down here, which we would target. We have an extreme up here, which we would target. In between, we're in the value area. We have moving averages as resistance. We have a swing level to get through on the downside, 200-day moving average. It's a technical picture that we're looking at, and the technicals are doing a pretty good, decent job of in this up and down market for this currency pair. So we'll see what happens in this trading week. Next currency pair I'm going to take a look at is the dollar versus Swiss. So let's get started. I'll take a look at the daily chart to start off. When we take a look at this currency pair, the price moved higher, traded to the highest level going back to this period right through here, which is back in November, October, or September even. Again, this is the daily chart, so it goes back a long way, certainly for the year. And in the process, we moved above the 38.2% retracement of the move down from this high to this low right through here. As everyone knows, I like to see the price stay above the 38.2% retracement to show that the buyers remain in control. And I tried to do that in trading last week, but could not sustain the momentum above the 0.9025 level, and we rotated back to the downside and moved back into this swing area through here between 0.8986 and 0.9017 to close the trading week. So it's a bit of a disappointment that we couldn't stay above the 38.2% retracement. Remember the 0.9025 level in trading this week. Let's take a look at the hourly chart next. And if we look at the hourly chart, and I'm going to put a horizontal line at the 0.9025 right there, and as you can see, the high price on Friday came right up to that 38.2% retracement level, again from the daily chart. You can't see it here, but that was the 38.2 of the longer term trend to the downside for the dollar versus Swiss, and we held resistance against it, started to move to the downside. We also did a pretty good job of finding resistance near it right through here as well. So these two levels right here were a good ceiling for the dollar versus Swiss, at least in the short term. Okay, it doesn't mean that it's going to stay below that level in the long term. In fact, the fundamentals sort of point toward the dollar Swiss moving to the upside. Also in play is the 100-hour moving average, just comes in just above that level now at 0.90275. So as we head into the new trading week, that's going to be our close resistance to get to and through. If we're able to get above that level, then we can give absolution for those sellers who push the price below the level and try to keep the price below the 100-hour moving average in the process. We'll forgive them for failing on that, and we'd start to look back toward our high prices as 0.90705, and then look higher because off the daily chart there is room to roam on the top side. As we saw here, the price the trend was largely to the downside, and we're just getting above the 38.2% retracement. So get above these levels and get above the 9070 level, and it opens the door for the upside. But I have to admit that we're in the short term, we're closing the week below the 38.2, below the 100-hour moving average, and so that's tilting the bias a little bit more to the downside. Now it's not a disaster because we have the 200-hour moving average down here to get to and through to increase the bearish bias, and then the 38.2% retracement of this move to the upside, this long-term move right through here, comes all the way down at 89.40. But those are the targets on further selling to get below the 200-hour moving average, get below the 38.2% retracement. We can talk about being more bearish in the shorter term, in intermediate term for the dollar versus Swiss. So those are our targets on the downside. So it's pretty simple. Get above the 25 level, get above the 27 level, and 100-hour moving average opens the door for more upside. It changes the bias a little bit. And then if we go below the 200-hour moving average and things turn a little bit more bearish, we look toward the 38.2 and see what happens at that level. So that's my look at the dollar versus Swiss. The next currency pair I'm going to take a look at is the dollar versus Canada. So let's get started. This currency pair is like the sterling versus U.S. dollar with lots of ups and downs. On the top side, we have this swing area right through here where we have a number of different swing highs and lows going back in time, right here, 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 here. before the market moved to the downside. Returned to it here, found sellers. 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 Returned to it here last week and found sellers as well. And so this area between the 1.36049 and 1.36269 is the swing area that if the buyers are going to take control, they need to get above those levels. But you can see in trading last week and then the week before, the price came into those areas right through here and found willing sellers, not once, not twice. Actually, not twice, not 3 times, not 4 times, not five different times. The price came into that yellow area and found willing sellers against that level. So guess what? That's a pretty strong ceiling for the dollar versus Canada. Now on the downside, what do we have? Well, we have with all this ups and downs, we've seen the 2 moving averages, the 100 and the 200 bar moving average on the 4-hour chart, all converging at the same level. That those converged moving averages also come near the 50% retracement level, and lo and behold, on Friday's trade we came down to that level, and Wednesday and Thursday's trade the price came down to that level, found support buyers or that cluster of support, and stalled. So going into the new week, this level right here, right around the 135.34 level, is going to be a level that we need to get to and through on the downside to increase the bearish bias. If we do so, then we'll look toward the 100 and 200 day moving averages. Those are these 2 moving averages at 134.94 and 135.03 respectively. Get below those levels and it opens the door for this trend line right through here and this low price right through here, which, by the way, corresponding with the 38.2% retracement of this move to the downside right through here. So there's a reason why the price held support not last week but the week before, and the week before that was the 38.2. And if we're going to go lower, we need to get below the 100, 200, and then get below the 38.2 to increase the bearish bias on the downside. So clear, like some of the other currency pairs, it's clear what we need to get through on the top side. First, stay above the 100 and 200, then work toward the swing area. On the downside, it's pretty clear what we need to do on the downside, get below these moving averages, and then 100 and 200 day moving average, obviously key, followed by the broken 38.2 and 1.34525. If we do that, then we open the door for further downside in the dollar versus Canada. Next currency pair I'm going to take a look at the Aussie versus US dollar. Looking at the Aussie versus US dollar as we enter into the new trading week, I would characterize last week's trading to be somewhat sloppy. Lots of ups and downs within each of the bars, and also overall for the week, we initially moved to the upside, and then to the downside, and the upside and downside, and back to the upside and back to the downside. And trading, there is, I don't know. I had a red line here coming in at this old level at 0.65229. It sort of made mincemeat of that. What we can say technically maybe is that the price tried to get above the 200-day moving average. That's this green line right through here. Couldn't sustain above those levels early in the week, and then things started to turn around with the price holding resistance against the 200-day moving average, and then this highs right through here, stalled against both the 200-bar moving average in the 4-hour and the 200-day moving average ahead of those levels, and moved to the downside. Also, this swing area right here did a good job of holding resistance midweek and pushing the price to the downside. We also moved below this trend line right through here, which I sort of had earmarked as a level of importance, and we tried to move below here midweek, but could not sustain momentum. So the buyers were trying, and the little engine that could sort of gave up, and it also made mess of the trend line as well. So it's kind of messy technically. It's maybe not as clear as some of the other currency pairs from a technical perspective, in that in its messiness there is inconsistencies, and makes it difficult for us as a trader, doesn't it? So I just put in a couple horizontal lines at the different lows for not last week, but the week before. And, I think we need to get below those levels. We did find support maybe against the low from the previous week right here on Friday before moving to the upside. We're moving back down toward that level. That comes in around the 0.6503 level. Let's call it 65, break below 65 level. We look down for further selling pressure with 0.6486, and this low right here, 0.64769 is the next targets on the downside to get to and through. And if we do that, then we'll look toward the other lows at the 68 level, and then back down to the around 45 level, which is actually a little bit below that, around the 43 level where the price has its low for 2024. So on the top side, What do we need to do? Well, these two moving averages sort of stick out to me. They're both converged to 200-day moving average, 200-bar moving average of the 4-hour chart. We need to get above both of those levels to show that the buyers mean business, and then we'll start to look toward the 100 and the 100-day moving average on the top side. So sloppy trading in the Aussie versus U.S. dollar has a little bit more of a bearish bias going to the new trading week. So we'll tilt in that direction as long as the price remains both below the 200 bar moving averages on the 4-hour chart and the daily chart. The bias remains more to the downside for this currency pair. The final currency pair I'm going to take a look at is the New Zealand versus U.S. dollar. So let's get started. Taking a look at the New Zealand versus U.S. dollars, we start the new trading week starting April 1st. The bias is more negative for this currency pair. There are a couple of reasons for that. And one is you see the swing area right through here. We had a number of different swing lows and swing highs going back in time through here, before we moved to the upside. It didn't return to that level until the end of last week, where the market came down and closed near the low of that swing area, also below the 61.8% retracement. In trading last week, the price moved higher initially, but we fell short of this target up here at the 0.6037 level, and the sellers started to re-enter, coming down to the low of the swing area through here, tried to hold support, and then broke below the level toward the end of the last week, Thursday and Friday, and stay below this swing area right through here. The other thing, we're below the 61.8% retracement. That's near the 60 level, 0.59989 to be exact, but the 60 level on the top side is going to be a target that we need to get to and through on the top side if we're going to turn the bias, at least in the short term, back to the upside. If we can't get above that level at the start of this trading week or during the week, then guess what? The sellers remain more in control. So that's why I consider this more of a bearish looking chart for the New Zealand versus U.S. dollar. The next target on the downside comes at the 0.5939 level, and then we'll start to look toward these swing lows right through here and swing highs through here, which form this swing area. Should have it in yellow, but comes between the 0.5857 and 0.58699. Admittedly, we went a little bit below the level here, but that gave it the oomph to go to the upside through here. So this area right through here is going to be another key target on the downside if the momentum continues for the New Zealand versus U.S. dollar to the downside, with between 0.5857 and 0.58698. So sellers remain more in control below this area with the 39 level, and then down to the 58.57, 58.69 area on the downside. Now, if we do get back above the 60 level, it changes the bias a little bit more to the upside, and we'll start to look toward this low price right here, which came in at 0.6037 32. 3.2 or 3.7. Looks like 3.7 on the top side. I need to get above that level, and then all up here is just all our moving averages. There's a big huge cluster of moving average, 50% retracement, swing area. All that would be the next targets on the top side that comes near the 0.6070 area. Up to really 85 down to 61. So that area right through here would be our next key target, followed by the other moving averages up here, including the 100-day moving average up near 0.6138. So sellers remain more in control below the 60 level in the New Zealand versus U.S. dollar to start the new trading week. Get above that level, it tilts the bias a little bit more to the upside with work to do. If we stay below that level, then we have the sellers remain in control with the potential to head down toward the 0.5860 type area on the downside for this currency pair. So that does it for a look at all the major currency pairs to start your new trading week, to kickstart your new trading week. I hope you found it interesting and helpful. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.